Here's a puzzle from this week's news. The White House spent a year taking control of America's interest rate machine. It installed a loyal chairman, and it's pushing out a board member who won't play along. Mission accomplished, right? Cheaper money for everyone. Except, look at the actual numbers. The rate the government controls, down. 3 cuts. Your mortgage, this week, 6.67%, higher than the day the winning started. And this week the government tried to borrow money for 30 years, and got charged its highest rate since 2007. So who's overruling the most powerful office on earth? Someone still is. Stick around, because they set your rates too. First, the takeover itself, because it's real, and it's the fastest one in the Fed's 113 years. The Fed is the referee that sets America's base interest rate. It was built to ignore presidents. This year, the White House put its own man in the referee's chair, Chairman Warsh, confirmed by one of the narrowest votes ever. Then it went after a board member who wouldn't cooperate, Governor Lisa Cook. No president had ever tried to fire a Fed governor. This one has now tried twice. The Supreme Court blocked round 1, and round 2 is running right now, with a deadline days away. So the pressure isn't subtle anymore. The plan was simple: control the referee, get cheap money. And that's exactly where the plan hit something it didn't expect. Here's what went wrong. In one picture, the lower line is the Fed's rate, the one the White House now effectively controls. Last fall, the cuts began. 3 of them. Now watch the upper line, your mortgage. At first, it followed. 6.6 down to 6.05. The plan was working. Then, this spring, as the new chairman moved in and the pressure got loud, it turned around and kept climbing. By this week, 6.67. Every penny of that discount, gone. Now look at the gap between the lines. That gap isn't interest, it's distrust, with a price on it. To understand who's charging it, you need to see who your mortgage rate actually answers to. It's nobody in Washington. Because here's the machine underneath. The Fed only sets one rate, the overnight rate, what banks pay to borrow money until tomorrow morning. Your mortgage is a 30-year promise. Different animal. Its price comes from the market for long government debt, the 10-year loan rate that everything else copies. And who sets that? Whoever shows up to lend. Pension funds, insurance companies, foreign savers, thousands of strangers, deciding what interest they'll accept to hand money over for decades. If they're nervous about the future, they simply charge more. Nobody can fire them. Nobody can take them to court. A president can capture the referee. He can't capture the crowd. And the crowd votes in public. It's called an auction. The government says how much it wants to borrow, and lenders bid the interest rate they'll take. America ran 3 big 30-year auctions this year. February, 4.75%. May, over 5%. And this week, 5.22%, the highest borrowing cost since 2007. Same government, same 30 years. 3 times this year, the crowd looked at Washington and said, the price just went up. Notice the order of events. The louder the takeover got, the more expensive the money got. That's the paradox driving this whole story. And here's the detail most news coverage missed: the markets tell. There's a rate that works like a prediction, the 2-year rate. It's basically the market's bet on where the Fed's rate will average over the next 2 years. If lenders believed the cheap money plan, it would sit below today's 3.75. Where is it? 4.2. Above it. Sit with that. The market looks at a Fed built to cut rates, and bets its next real move is a hike. Why? Because prices are still rising at 3.5% a year, an oil shock just passed through, and a referee who answers to politicians might let inflation slide. So lenders protect themselves, in advance. The takeover was supposed to buy cheaper money. The market is quietly pricing the opposite. If this feels new, it isn't. America ran this exact experiment before. 1972. President Nixon leaned on his Fed chairman, an old friend, to keep money cheap through the election. It worked. He won 49 states. Inflation that year looked harmless, 3.3%. Then the bill arrived. 6% the next year. 11% the year after, and America spent a decade fighting it, with interest rates that eventually had to go past 15. Here's the lesson hiding in that curve. The damage didn't show up before the election, when it could have changed minds. It showed up after, when nobody could give it back. Pressure on the referee is a loan. The interest comes later. And if you want the same experiment at full volume, it happened this decade. Turkey, 2021. The president there went past pressuring his central bank and simply ran it, firing chief after chief until one agreed to cut. Rates went from 19% down to 14%, with inflation already rising. What happened next? The currency lost half its value in months, and inflation went vertical, past 50, past 70, peaking at 85%, groceries doubling in a year. Now, America isn't Turkey. Dollars have protections the lira never had. But the mechanism doesn't care about the flag. When savers stop trusting the referee, they don't write angry letters. They just reprice everything. Okay, what does this mean for your money? 3 honest readings, and remember, this channel never tells you to buy or sell anything. 1. If you're waiting to refinance your house, everyone says watch the Fed. You now know that's the wrong dial. Your rate follows the 10-year, and the 10-year follows trust. 2. The old rule said Fed cuts lift bond funds. That rule assumed a trusted referee. This year the cuts came, and bond funds fell anyway. A broken rule is information. 3. The tricky one. Parking cash short-term pays about 4%, and official inflation says 3.4. So on paper, cash wins. By a hair. But maybe your grocery receipt disagrees with the official number. Millions of people believe prices run hotter than reported, and that it's no accident. That idea has a name. Debasement. A government drowning in debt lets its money quietly shrink. So its old debts shrink with it. If that's what's happening, even 4% interest is losing, just slowly. I won't tell you which number to believe. But here's the thing. The fight you watched tonight, politicians versus the bond market, is this exact argument. With trillions on the table, lenders are demanding extra interest because they fear thinner dollars. So watch what they charge. They're betting real money on the answer. 5 things to keep after tonight. Whoever controls the printing press still doesn't control the price of trust. The rate that runs your life is set by a crowd, and the crowd can't be fired. Political wins over money tend to send the bill later, after the applause. When a market rule breaks, like cuts lifting bonds, the chart is telling you who to stop trusting. And the loudest week in Washington was priced, quietly, at an auction most people never heard about. This was Act 3 of a story we've been following all year. Act 1. Who really sets your interest rates? It's on your screen now. Act 2. The week the bond market went to war over oil. And Act 3 ends with a date. Days from now, the deadline in the Governor Cook fight, and weeks later, the referee's next rate decision, taken while the whole crowd watches his boss. We'll be here for both. Nothing tonight was financial advice. It's how the machine works, so the news makes sense. If it helped, subscribe. Technology and Money, explained like a human.